Okay, let's jump right in. We're talking about Ray Dalio today, billionaire investor, founder of Bridgewater Associates. It's the world's largest hedge fund. And he has some pretty significant concerns about the economy.
That's right. He's definitely someone people listen to in the financial world.
Absolutely. And just quickly, before we really get into the weeds, if you find this topic interesting, please do hit that like button and subscribe. It helps others find the discussion.
Good point. So Dalio, he's also got a book coming out soon, I think in June, called How Countries Go Broke.
Right. And he frames his perspective as being, well, apolitical, doesn't he?
He does. He tries to step back from the day-to-day politics. And from that viewpoint, he sees all this talk about tariffs as really just a symptom.
A symptom. Okay.
Yeah.
A symptom of what exactly? What are the bigger things he thinks are driving everything?
He lays out these 5 major historical forces, big picture stuff. He believes they're always interacting, kind of shaping the environment we're in.
5 forces. Okay, what are they?
So first, there's the classic money, credit, and debt cycle. You know, the economic engine, expansions, contractions, that whole thing.
The booms and busts. Got it.
Exactly. Then number 2 is internal conflict. That's the tension within a country.
Like political divides, left versus right.
Yeah, that, but also wealth gaps, clashes over values, that sort of internal friction.
Okay, makes sense. What's the third?
Third is international conflict. Think rising powers challenging existing ones.
Like China and the U.S., for instance.
That's a classic example of the dynamic he's talking about. And he also notes a shift here, moving away from that post-war multilateral system, you know, led by the U.S., towards countries acting more on their own, more unilateral.
Right, less cooperation. Okay, that's 3. What else?
Fourth is acts of nature, things like droughts, floods, pandemics, obviously, big natural events that can have huge economic impact.
We've certainly seen that recently. And the 5th?
And 5th is technology, just the constant change, the disruption that comes from new innovations.
Okay, so those 5. Money cycle, internal conflict, international conflict, nature, and technology.
Right, and he stresses it's not just one of these things, it's how they all interact. That's what creates the specific situation we're facing now.
And looking at those forces, Dalio suggests some things just aren't sustainable.
Imbalances.
That's right. What kind is he focused on?
Yeah, exactly. Imbalances. He's talking about things like how capital flows between countries and trade imbalances, too. He thinks these kinds of gaps just can't keep going indefinitely, especially with those bigger forces pushing and pulling.
Okay, so that brings us back to tariffs, which are constantly in the news. How does he see, say, President Trump's tariffs fitting into this bigger picture he's painted? Good, bad?
Well, he says it really depends on how they're implemented. He gets the stated goals, you know, raising revenue, trying to bring back manufacturing, jobs.
Yeah, those are the arguments you hear.
Right, but for Dalio, the key is how it's done. Is it through, like, careful policy and real negotiation that solves underlying problems for everyone, or is it more
abrupt, predictable, creating friction? And which way does he think it's gone so far?
His take is that up to now, it's been pretty disruptive.
Disruptive how?
He uses this analogy like throwing obstacles into the gears of the global production system.
Okay, so gumming up the works, basically.
Yeah, leading to inefficiencies, higher costs, potentially. He says the final outcome really depends on what happens in any negotiations after the tariffs are put in place.
A lot of people are worried about recession. Does Dalio think these tariff policies could actually tip the U.S. economy into one?
He suggests we're definitely at a critical point, a fork in the road, maybe, where the decisions being made now could push us very close to a recession.
Okay, close to a recession.
But he also seems worried about, well, potentially worse outcomes than just a standard recession if these big underlying issues aren't handled well.
Worse than a recession. Okay, that sounds serious. What does he mean by worse? What scenarios is he thinking about?
He actually raises the possibility of a breakdown in the whole international monetary order.
Wow.
Yeah. His argument is basically that government spending levels are just too high, they're unsustainable. And this creates problems for the dollar, and it ties into using tariffs as a tool. Plus, he sees big shifts happening domestically, politically, and in the global order, too.
So multiple things converging.
Exactly. And he draws parallels. He looks back at the 1930s. He notes that history often, rhymes or repeats itself.
He explicitly mentioned the 1930s in the context of worse than recession. That's stark, especially coming from someone who famously called the 2008 crisis. What's his overall feeling now? Where are we heading?
He sees it as a really decisive moment. He keeps coming back to the federal budget deficit. He says, look, if we can get that down to maybe 3% of GDP,
which is way down from where it is now?
Way down. But if that could happen, and if trade issues are managed responsibly, he thinks we could navigate this. He even suggests, kind of pointedly, repeatedly that Congress should commit to hitting that 3% target.
It's a specific target.
Yeah, but if those things don't happen, he warns about a potential mismatch. Too much government debt being issued, not enough demand for it, happening right when all these other economic and geopolitical tensions are high. That combination, he thinks, could lead to something worse than just a normal recession.
So when he says worse than a recession and he brings up the 1930s, what specifically is he afraid of? Is he talking like depression-level stuff?
His main worry seems to circle around the value of money itself, its fundamental stability.
Okay.
He explains it like this. A bond is basically stored wealth, right? Your asset is someone else's debt.
Sure.
His fear is that if there's just too much debt out there, way more supply than demand, it undermines that store of wealth, maybe leads to serious inflation, and that causes major economic disruption.
So like a currency crisis.
Potentially, yeah. He puts it maybe on par with like the collapse of Bretton Woods back in 71 or even 2008, but maybe worse if these internal political conflicts and international conflicts also heat up at the same time as an economic downturn.
What's the absolute most concerning scenario he paints? What's the core message he wants people to grasp?
He really highlights a few things. One, this potential loss of faith in the value of currency. Two, internal conflicts, societal divisions becoming so bad they break outside normal democratic processes.
Right.
And three, international conflicts damaging the global economy significantly. He even mentions the possibility of military conflict, drawing on historical patterns where economic stress and geopolitical tension led to breakdowns in order.
So breakdown is the key word.
Yeah. He basically observes that the global system we've had since 1945, like all systems before it, goes through cycles. And he's concerned we could be heading towards a breakdown of the current order, though he does stress it's not inevitable if we take the right steps.
Which leads us back to his upcoming book, How Countries Go Broke. Does he offer solutions in his talks? What does he think should be done?
He mentions several possibilities, but the one he really hammers home, especially when time is short, is getting that budget deficit down to 3% of GDP.
Back to the 3%.
Back to the 3%. He thinks it's possible, believes bipartisan cooperation could achieve it. He points to the period like 91 to 98 when there was a real effort to work together on fiscal issues.
So cooperation is key domestically. What about internationally?
Internationally, he basically advocates for the U.S. using its strength to negotiate effectively, to find paths that avoid damaging conflicts and inefficient policies, basically manage these complex issues smartly.
Let's circle back to tariffs for a moment. You mentioned he agrees with the problem they're trying to solve, but not necessarily the solution itself. Can you elaborate?
Yeah, he's clear on that. He says, okay, I see the issues, the imbalances in capital flows and trade, the loss of manufacturing here at home. He agrees those are real problems. But he has serious doubts about tariffs being the right tool. Just on a mechanical level, he points out, tariffs raise costs for companies and they lower revenues. Pretty straightforward.
Okay. And what about the argument that tariffs will bring back manufacturing, rebuild the industrial base?
He questions how practical that is, at least quickly. He agrees with the goal, more domestic production is good, but he points to a potential mismatch.
A mismatch how?
In workforce skills, primarily. He suggests that a significant part of the U.S. workforce might not currently have the skills needed to just slot into those manufacturing jobs if capacity were suddenly shifted back from overseas. It's a structural issue.
So it's not as simple as just putting up tariffs and factories magically reappear with trained workers.
That seems to be his view. He thinks trying to force it solely through tariffs risks causing major disruptions, messing up global production networks, supply chains, all that.
So he sees the problems tariffs are aimed at, but thinks they're maybe the wrong medicine, or at least a risky one.
That's a good way to put it. He thinks tariffs are a potentially harmful tool for these really complex long-term issues like trade balances and national competitiveness. He agrees we need to address those things, just maybe not primarily this way.
And he linked the budget deficit back to tariffs too, right?
Yes, definitely. He emphasizes that getting the deficit down to that 3% mark is just as important, maybe even intertwined with the tariff situation. He seems worried about the negative effects if both things, the tariff friction and the large deficit, are happening at the same time.
So it compounds the risk.
Right. He keeps stressing that the fundamental issues, debt, government overspending, overall competitiveness, those haven't gone away. They still need addressing.
Okay, so to sort of synthesize Dalio's view, these tariffs aren't happening in a vacuum. They're a symptom, or maybe an accelerant, of much deeper issues in the global money system, politics within countries, and geopolitics between them.
Exactly.
And he's concerned that if these big interconnected problems aren't managed carefully, particularly particularly the debt and deficit, the outcome could be much worse than just a standard recession.
Mm-hmm.
So while he might agree with why someone might reach for tariffs, he has serious doubts about whether they'll work as intended and worries about the disruption they cause, especially alongside the deficit.
That's a very accurate summary of his perspective. He frames it all in that much broader historical and economic context and really brings it back to those fundamentals like debt, fiscal responsibility, and managing conflict.
It certainly gives you a lot to think about, puts the daily headlines into a much bigger framework. Thank you for walking us through his analysis.
You're welcome. Glad to do it.
And thanks to all of you for tuning in. If you found this perspective valuable, please remember to hit like and subscribe so you don't miss our future discussions. We'll see you next time. Goodbye for now.